Hello, this is a follow-up video to a couple of others I've done. You can check out the other videos if you follow these two links here. Now, the first video was on day trading and how it is a losing proposition. Well over 90% of day traders end up losing money relative to putting it into a mattress, let alone relative to the market in general. The second one talks about how high-frequency trading exacerbates this challenge. Now, today, I want to talk a little bit more about high frequency trading. How did it get started, and what are the intentions or what are the ideas behind it? All right, so to kind of get started, the characteristics behind high frequency trading are that companies use powerful computers and algorithms to rapidly make a ton of little tiny changes very, very quickly with massive turnover, high order to trade ratios in order to provide liquidity to the market and make money at the same time. That's kind of the basic characteristics of it. How did this get started? Well, exchanges want to be used, right? So in order to be competitive, they need to have liquidity there. You would never go to an exchange that had very poor liquidity. If you couldn't trade stocks on that exchange, you wouldn't go there. So they want to be able to do that. They also want to have they want to provide some safety too. So if you think about the financial crisis, Lehman Brothers, one of the big concerns was there wasn't enough liquidity in the market. That helped contribute to the problem. So it all goes back to liquidity. Liquidity provides competition. It provides market safety when people need to get in or out of securities. And the solution to this is SLPs. So what are SLPs? SLPs are supplemental liquidity providers. And what they do is the exchanges have decided that if you are willing to provide liquidity, if you're willing to be one of these SLPs, they will give you a rebate. So it's very, very small. It's 12 basis points of a dollar. But the thing is, you're doing millions and millions of orders, and this adds up. So the exchanges, in order to provide the safety, in order to provide the liquidity, they're willing to give certain players a small rebate in order to provide that. Now, who are the big players? These are the three big players in the high frequency trading world: Tower, Virtu, and Citadel. Of course, there are others, but these are three big players in the market. Now, the basic idea here is that with these players, the trading is faster, there's better liquidity, spreads are lower, execution's better. So if you look at this chart, you can just kind of see that bid-ask spread gets lower, the trade happens faster, and the idea is it's supposed to be a win-win for everybody. So investors, high-frequency traders, exchanges, everybody, the market, everybody wins. Now, of course, that's not the whole story. So next time we're going to talk about kind of the benefits and, more importantly, the criticisms of high frequency trading. So we have a nice balance of ideas there. That'll be next time. Thanks so much for listening.